Most Americans believe the IRS exists mainly to collect their money, but if you take the time to study the tax laws, you discover something remarkable. There are complete sections created specifically to compensate you for choosing particular investments. These are not tax reductions, not loopholes. The government actually provides you with funds when you direct your dollars into the areas they seek to develop. I am going to reveal precisely which investments the IRS compensates you for making, how much compensation they offer, why 90% of Americans never engage with even one of them, and how affluent individuals have discreetly employed these approaches for the past 100 years to create the sort of lasting family wealth that most individuals assume requires being born into privilege. By the conclusion of this video, you are going to view the tax laws not as an instrument of control, but as an options list that lawmakers prepared deliberately to encourage specific actions. And if you simply select the choices from that options list, the IRS will compensate you to pursue the lifestyle the government prefers you to pursue. Let me begin with the single most essential idea in the whole tax laws, because if you grasp this one concept, all the rest starts to make complete sense. The tax laws are not created to be equitable, they are created to encourage specific conduct. Every individual provision in the tax laws was prepared by lawmakers to direct funds toward particular goals: housing, energy, business, investment, retirement, education, charity. If you engage in what the tax laws encourage you to engage in, the tax laws will support you financially. If you disregard the tax laws and simply hold a W-2 position and receive a salary, you face the highest overall tax percentage in the nation. The average W-2 worker pays something between 25 and 37% of their earnings in federal taxes, state taxes, payroll taxes, and indirect costs. The average affluent American pays closer to 15%, not because they employ superior accountants, but because they recognize the law's function as an options list, and they selected from the appropriate section of the options list. Now, let me guide you through the investments the IRS actively compensates you for making. The first one is so straightforward, it frustrates people when they finally realize it. Launch a business. The instant you operate a valid business, every financial interaction in your life transforms. Every laptop you purchase, every phone you utilize for work, every journey you make for a customer, every meal you consume while consulting a potential client, every mile you travel between meetings, every membership you maintain to manage your activities, every dollar you expend training yourself about your field, all of it becomes allowable as an expense. And I am not referring to some minor portion. Under Section 179 of the tax laws, you can expense up to $1 million of business assets in the same year you acquire them. A typical employee earning $100,000 pays taxes on $100,000. A business proprietor earning the same $100,000 can lawfully subtract tens of thousands of dollars in costs before the IRS ever reviews a cent. That is not a scheme. That is the tax laws operating exactly as they were intended. Lawmakers desire more small businesses in America. They prepared the regulations so that the more you commit back into your business, the smaller your tax payment becomes. And it builds over time. A business proprietor who commits strongly to their activities can lawfully operate with a reported deficit for years while genuinely developing actual value and actual revenue underneath. That is the approach. The second investment the IRS compensates you for making is real estate, and I want to devote substantial attention to this one because this is where affluent people discreetly develop lasting money. When you purchase a rental property, the IRS permits you to subtract something known as depreciation. Here is how it functions. The tax laws presume that the physical framework of a structure gradually deteriorates and declines in worth over time. For residential property, the presumed duration is 27.5 years. For commercial property, it is 39 years. So the IRS allows you to take the worth of the structure, divide it by that figure, and expense it against your earnings every single year. A $500,000 rental property with a $400,000 structure worth provides you roughly $14,500 in depreciation expenses every year for nearly 3 decades. That is $14,500 of earnings that the IRS acts as if you did not receive, even though you did. But here is the element that will surprise you. the property is not actually declining in worth in most situations. In fact, it is typically increasing. So you are gathering rent. You are developing equity. You are observing the property increase in value, and the IRS is still lowering your taxable earnings by tens of thousands of dollars a year based on an imaginary depreciation that is not truly occurring. This is known as a phantom loss. It is a loss on records that is actually a benefit in practice. It is one of the most elegant accounting setups in the entire tax laws. Now, combine that with something known as a cost segregation analysis. This is where a qualified engineer examines your property and pinpoints every element that has a briefer useful duration than the structure itself. Items like carpeting, appliances, lighting equipment, landscaping, and parking area surfaces. Those elements can be depreciated over 5, 7, or 15 years instead of 27, which means you can accelerate large amounts of depreciation into the initial years of ownership. A knowledgeable investor with $1 million rental can lawfully claim $150,000 to $250,000 of depreciation in the first year alone. That is a substantial subtraction against active earnings if you meet the standards as a real estate professional. And then we arrive at the 1031 exchange. Section 1031 of the tax laws states that if you sell one investment property and reinvest all the returns into another investment property inside a particular period of time, you do not have to pay any amount of capital gains tax on the transaction. You can perform this unlimited times. You can purchase a modest rental, sell it, reinvest the returns into a larger rental, sell that one, reinvest the returns into an even larger one, and continue indefinitely. You never pay the tax. And when you pass away, your beneficiaries receive the property at what is known as a stepped-up basis, which means all those decades of increases are entirely eliminated for tax reasons. The government literally permits affluent people to develop and pass along real estate holdings without ever paying capital gains tax on any portion. This is not unlawful. It is not hidden. It is included directly in the laws. Most people simply never examine the laws. Now, let me proceed to the third investment because this one hardly anyone discusses, and when I describe it, you are going to realize why affluent people remain so reserved about it. Energy. The federal government seeks American energy development. They seek it so strongly that they establish tax benefits so powerful they nearly appear untrue when you first learn about them. If you invest in oil and gas through what is known as a working interest, you can subtract between 65 and 80% of your investment in the initial year through something known as intangible drilling costs. Let me illustrate that with actual figures. If you commit $100,000 into the appropriate energy venture, you can lawfully expense up to $80,000 against your active earnings right away, not distributed across years, not introduced gradually. Right away in the first tax year. This is one of the few investments in the entire tax laws that permits you to subtract against W-2 earnings. It is deliberately reserved for this precise goal, because lawmakers want private funding to support American energy. And if you favor renewables, the solar investment tax credit provides you 30% of your installation cost back as a direct credit. I want to be completely clear about what a credit represents, because a credit and a subtraction are two entirely separate things. A subtraction lowers your taxable earnings. A credit lowers your tax obligation dollar for dollar. If you owe the IRS $20,000 and you receive a $10,000 tax credit, your obligation falls to $10,000. It is immediate money from the top. So if you install a $100,000 solar system on your property, you receive $30,000 back, not as a repayment of your costs, but as a reduction of what you owe in taxes, and you still possess the solar system, which produces electricity that either reduces your costs or gets sold back to the grid. That is the government compensating you to possess energy production. There are also tax credits for wind energy, geothermal systems, battery storage, and even for purchasing certain electric vehicles. The Inflation Reduction Act, despite its confusing name, was actually one of the largest collections of energy investment tax credits in American history. It simply was not promoted to ordinary people. It was created for businesses and affluent investors who would understand how to apply it. And that is the central idea of this entire video. The tax laws reward individuals who understand how to apply them, and it overlooks people who do not even realize it is there. The fourth investment category is retirement accounts. And I know everyone has heard of retirement accounts, but almost nobody applies them properly. A standard 401k permits you to postpone about $23,000 a year. In 2026, that is the standard employee contribution limit. But here is where it becomes compelling. If you own a business, even a modest side business, you can establish a solo 401k and contribute up to $69,000 in a single year. That is 3 times the limit of a standard employee account. You are contributing both as the employee and as the employer at the same time. And every single dollar of that contribution comes directly off your taxable earnings. A business proprietor making $200,000 can contribute $69,000 to their solo 401k and immediately lower their taxable earnings to $131,000 at a 32% tax bracket. That is over $22,000 in tax savings in a single year every year for the rest of your career. And then there is the premier element of the entire retirement framework, the health savings account. The HSA is the only account in the entire United States tax laws that provides you a triple tax benefit. Money goes in tax-free. Money grows tax-free. Money comes out tax-free when used for qualified medical costs. There is literally no other account in the entire laws that provides you all 3 of those benefits at the same time. Traditional 401k provides you tax-free going in and tax-free growth, but you pay taxes coming out. A Roth IRA provides you tax-free growth and tax-free coming out, but you pay taxes going in. An HSA is the only one that provides you all 3. And here is the detail that almost no one applies. You do not have to withdraw the money for medical costs at the time you incur them. You can pay medical costs from your own funds, retain the records, allow your HSA to grow for decades, and then reimburse yourself later at any point in the future. Which means the HSA can quietly operate as an additional retirement account with the best tax treatment of any account in existence. Now, I want to extend past the 4 primary categories, because the tax laws contain many smaller, lesser-known approaches that can build upon each other and multiply your savings. Let me guide you through a few of the ones affluent people employ that almost no one discusses openly. First, opportunity zones. This was established in 2017, and it is remarkable. If you take capital gains from any investment, stocks, real estate, crypto, business sale, and you reinvest those gains into a designated opportunity zone fund, you get to postpone the capital gains tax on the original investment until 2026. And if you hold the new investment for 10 years, every single dollar of gain on the new investment is completely tax-free. Forever. No capital gains tax at all on a 10-year hold. This was designed to direct private funding into economically challenged areas, but affluent people have applied it to develop multi-million-dollar tax-free investment holdings. Second, the Augusta Rule, which is Section 280A of the tax laws. This is a regulation that states you can rent your personal home to anyone, including your own business, for up to 14 days per year, and collect the rent completely tax-free. Not reduced tax, not lower tax, zero tax. If you own a business and you hold quarterly meetings at your own home, you can pay yourself $2,000 a day in rent, claim a full business subtraction, and personally collect $28,000 a year tax-free. It is one of the cleanest and most overlooked approaches in the entire laws, and it is completely legal as long as the rent is reasonable and recorded. Third, employing your children. If you own a business and you have children, you can pay them a reasonable salary for genuine work performed in the business. Under current regulations, children under 18 working in a parent-owned business do not have to pay payroll taxes. And if their total salary stays under the standard deduction, they pay 0 federal income tax on those earnings. So you move earnings from your high tax bracket to their 0 tax bracket, obtain a full business subtraction on the salaries, and transfer wealth to the next generation while they develop genuine abilities. A family with 2 kids can lawfully shift $30,000 a year off the parent's tax return. This way, fourth, qualified small business stock, which is Section 12(2). If you invest in or establish a qualifying small business and hold the shares for at least 5 years, you can exclude up to $10 million of gains from federal taxes. Not reduce, exclude completely. This is one of the reasons so many Silicon Valley founders pay almost no tax when they exit. They qualified under Section 1202, and the first $10 million of their gain is eliminated before the IRS even gets to review it. Fifth, the step-up in basis at death. When you pass away, your beneficiaries receive your assets at the fair market value on the day you passed, not at the price you originally paid. This means all the capital gains you accumulated during your lifetime vanish completely for your beneficiaries. Someone who bought stock at $10 a share and watched it grow to $1,000 a share over 40 years can pass that stock to their children with a brand new basis of $1,000. When the children sell, they owe nothing in gains. This is how lasting family wealth builds without ever being taxed. Sixth, the Roth conversion ladder. You take money from a traditional IRA, pay the tax on it during years when your earnings are low, convert it to a Roth IRA, let it grow tax-free for 5 years, and then withdraw it completely tax-free. Used properly, this lets high-income earners develop tax-free retirement accounts, even though they were technically above the direct Roth contribution limit for most of their working lives. Seventh, the research and development tax credit. If your business expends money on creating new products, enhancing existing products, testing new methods, or building custom software, you can qualify for a federal tax credit that can be worth up to 20% of those costs. This is not just for pharmaceutical companies or semiconductor manufacturers. A small software company, a custom fabrication shop, a food and beverage company developing a new recipe, an engineering firm designing custom solutions. All of them can qualify. The average small business owner does not even know this exists. The average tax accountant does not know how to claim it properly. But the companies that do know have lawfully shifted tens of thousands of dollars per year out of their tax obligation and back into their own funds. Eighth, the backdoor Roth IRA. If you earn too much money to contribute to a Roth IRA directly, you can still lawfully get money into one. You contribute to a traditional IRA on an after-tax basis, then immediately convert it to a Roth IRA. This is completely legal. It has been approved by the IRS in published guidance. It lets high earners develop tax-free retirement wealth that grows completely outside the reach of future tax increases every single year. You can do this in every single year. Most people who could benefit from it never even hear about it. Ninth, the Mega Backdoor Roth. This is the larger version of the regular backdoor Roth. If your employer offers it, you can contribute up to around $46,000 per year into a Roth account on top of your regular contributions by using after-tax contributions that get converted or rolled over. This can accelerate your tax-free retirement account by hundreds of thousands of dollars over a working career. It is one of the quietest benefits in the entire laws, and it only exists for people who bother to ask their plan administrator whether it is available. 10th, historic rehabilitation tax credits. If you buy and restore a certified historic building, the federal government provides you a 20% tax credit on the qualified rehabilitation costs. That means if you spend $1 million restoring a historic property, you get $200,000 back as a direct reduction of your tax obligation. Combine that with depreciation, cost segregation, and real estate professional status, and you can lawfully develop a real estate holding around historic properties while paying almost nothing in tax. 11th, low-income housing tax credits. This one is not for the average person, but if you have the capital to invest, the government will compensate you directly for building affordable housing. The credits can be worth up to 9% of your qualifying investment every year for 10 years. That means the government effectively pays back 90% of your investment in tax credits over a decade, while you still own the property and collect the rent. This is why the largest private investors in low-income housing are insurance companies and wealthy families. They understand the math. 12th Section 529 plans with Roth conversion. Starting recently, unused money in a 529 education savings plan can be rolled into a Roth IRA for the beneficiary up to $35,000 in total. So even if your children do not end up using all the money you save for their education, it does not get lost. It gets converted into a tax-free retirement account in their name. You can front-load a 529 plan early in a child's life, let it grow for 18 years, pay for their education, and then pour the leftovers into their retirement account. That is intergenerational wealth transfer with tax-free growth at every single step. Now, let me guide you through an example that shows how these build, because this is the part that changes how you think about money forever. Imagine you are a business owner making $250,000 a year, without any tax planning at federal plus state plus self-employment tax rates. You are probably handing between $80,000 and $90,000 to the government every year. That is more than 30% of your entire gross income gone before you even get to live your life. Now, let me guide you through the same person using the approaches I just described. You put $69,000 into a solo 401k. You put $8,000 into a health savings account. You buy a $300,000 rental property and claim roughly $10,000 in depreciation. You do a cost segregation study and accelerate another $30,000 of depreciation in the first year. You pay your teenage children $12,000 each for real work in the business, moving $24,000 off your return into their zero tax bracket. You put $100,000 into a carefully vetted oil and gas working interest and deduct $80,000 of it. You use the Augusta rule and collect $28,000 in tax-free rent from your own business. Add up the subtractions. You just lawfully eliminated around $240,000 of taxable earnings. Your effective tax rate drops from the mid-30s into the single digits. You just put somewhere between $50,000 and $70,000 back into your own pocket in a single year. Every year forever. All of it legal, all of it recorded, all of it included in the laws by lawmakers. And that is just year one. Now imagine that same person builds those approaches year after year. The rental properties grow in number. The retirement accounts compound in a tax shelter. The HSA grows into a hidden medical reserve. The children grow up with real work history and real Roth accounts in their own names. The business becomes more valuable because it is being reinvested in aggressively. 10 years from now, that business owner has somewhere between $1 and $3 million in additional net worth compared to the version of themselves that did nothing and just paid the standard tax bill. That is not hypothetical. That is the math. That is what happens when you actually use the laws instead of complaining about it. Now, here is the part that actually matters. And this is what I want you to walk away with. The reason most Americans never engage with any of these approaches is not because they do not qualify. It is because nobody ever explains that the tax laws function as an options list of benefits. Your high school did not teach you this. Your college did not teach you this. Your employer did not teach you this. Your financial advisor probably did not teach you this either, because most financial advisors are trained to sell products, not approaches. So the laws sit there full of benefits waiting for someone to examine them. And most Americans never do. Lawmakers use the tax laws to direct funds toward the activities they want more of: businesses, housing, energy, retirement, education, conservation, charitable giving. Every single one of those categories has a bright green sign flashing next to it that says, "The government will pay part of the bill for you if you participate." The government is literally putting its hand in its pocket and saying, "Here, take some of this money if you will just do what we are asking." And most people walk right past the sign and complain about how high their taxes are. The people who build real wealth are not the ones who work harder. They are the ones who read the instructions. The tax laws are the instructions. You just have to stop treating the IRS like an opponent and start treating it like a rule book. Because once you know the rules, you stop playing defense and you start playing the same game the affluent have been playing for 100 years. And that is the game where the IRS actually compensates you. And I want to leave you with one more thought because I think it is the most important thing anyone can understand about taxes. Most people think they are paying taxes because they are being penalized for being successful. They are not. They are paying taxes because they have not yet learned how the system was designed. The system was designed by people who expected you to invest in businesses, own real estate, fund energy, save for retirement, and build wealth. The system was designed for active participation, not passive observation. The moment you become an active participant, you stop being a tax victim and start being a tax beneficiary. The IRS is not your opponent. The IRS is an incentive program dressed up as an enforcement agency. The sooner you see that, the sooner you start getting paid instead of paying. Read the laws. Hire the professionals who know the laws. Invest in the things the laws reward. Stop complaining about the system and start using the system. And remember, every single approach I just walked you through is 100% legal, 100% recorded in plain language in the Internal Revenue Code, and 100% available to you right now. As soon as you decide to start participating instead of observing, the IRS is waiting to compensate you. You just have to learn how to ask for it. One last thing before you go. If nothing else you take from this video, take this. Every single wealthy family you have ever heard of got there by understanding one thing that ordinary people never do. They learned that money is not earned the way most people think it is earned. It is not earned by working harder. It is earned by positioning yourself inside the parts of the tax laws that lawmakers subsidize. A dollar earned at a W-2 job is taxed at 40%. And then you get to spend what is left. A dollar earned through business ownership, real estate, or properly structured investments gets taxed at 0, 10, or 15%, sometimes less, and then it gets reinvested and compounded for decades. That gap is the difference between staying where you are and building something generational. Make the decision today. Do not wait until next year. Start with one approach, implement it, then add another and another. This is how real wealth is built. One legal tax advantage at A.